Risk management in banking. Already we have discussed about credit risk and different types of other risk. Meaning, credit risk is the risk of a loan arising from a borrower's failure to repay finance principal or interest on time as per the agreed terms. Source credit risk, loans and advances, bonds and debentures, interbank lending, and trade finance. Traditionally, credit risk has been assumed by the bank originating the loan. However, due to securitization, credit risk can be transferred to third party investors in exchange for assuming credit risk. Third party investors receive a claim on the mortgage assets and related cash flows. Another risk is here about market risk. The valuation of MBS mortgage backed securities and CDO collateralized debt obligations is complex. The valuation is linked to the collectibility of subprime mortgage payments and the existence of a variable market for these assets. During the crisis, rising mortgage delinquency rates reduced the demand for such assets. Banks and institutional investors recognized substantial losses as they revalued their MBS downward. Several companies that borrowed money using MBS or CDO assets as collateral faced margin calls as lenders executed their contractual rights to get their money back. Measurement tools, credit rating and scoring models, probability of defaults, loss given defaults, exposure at default, credit VAR, management techniques, proper credit appraisals, diversification of loan portfolio, collateral and guarantees, credit limits and exposure norms, monitoring NPAs, provisioning and capital adequacy, Basel norms, liquidity risk. Liquidity risk is the risk that a bank will not be able to meet its financial obligations when they fall due to without incurring significant losses. Types: funding liquidity risk, inability to obtain funds, market liquidity risk, inability to sell assets quickly. Many companies relied on access to short-term funding markets such as the commercial paper and repo markets. However, because concerns regarding the value of the mortgage asset collateral linked to subprime loans, the ability of many companies to issue such paper was significantly affected. In addition, the interest rate charged by investor to provide loans for commercial paper increased substantially above historical levels. Measurement tools, liquidity gap analysis, cash flow projections, liquidity coverage ratio, LCR, net stable funding ratio, NSFR, management techniques, maintaining liquid assets, SLR, cash reserves, diversification funding sources, contingency and funding plans, asset liability management, ALM, stress testing, and scenario analysis. Interest rate risk, meaning in, interest rate risk is a risk of loss due to adverse movements in interest rate affecting a bank's income and asset values. Types: repricing risk, yield curve risk, basic risk, optionality risk. Measurement tool: gap analysis, duration analysis, earning at risk, economic value of equity, value at risk. Management techniques: matching maturities of assets and liabilities, interest rate, swap and derivatives, fixed versus floating rate balance, ALCO monitoring and hedging strategies. Counterparty risk. Counterparty risk is the risk that the other party in a financial contract will fail to fulfill its contractual obligations. Where it arises: derivative contracts, swap, forwards, futures, interbank transactions, securities trading, repo agreements. Major investment banks and other financial institutions took significant positions in credit derivatives transactions. Due to the effects of credit, market, and liquidity risk, the financial health of investment banks declined, rising counterparty risk credited further uncertainty of financial markets. Measurement tools: current exposure method, potential future exposure, PFE, credit valuation, adjustment, CVA, management techniques, setting, counterparty limits, collateral agreements, margining, netting arrangements, regular credit assessment of counterparties, use of central clearing parties, CCPs. I think you learn about KYC. Anyone can answer what is KYC? What is KYC? KYC means knowing your customer. Know your customer. As these examples illustrate, client and legal problems can lead not only to financial pain but also reputational problems. These disputes have a nasty habit of being ventilated in the public domain, thereby potentially damaging perception and financial standing. Whether or not there is fault, it is often, therefore, the reputational aspects of the conflict that are the driving force for management. Those sustaining such damage are not always able to survive witness BT, ultimately subsumed by Deutsche Bank after a series of client derivatives problem irreparably damaged public confidence in the bank, and Anderson broken apart after the Enron collapse led to client departures and criminal indictment. Enron projects failed due to the strikes of the people, local people. A strong and disciplined approach to dealing with clients is therefore a prerequisite to a well managed company. A central part of the process must center on a firm's client's risk philosophy. We should clearly delineate the types of clients the firm intends to target, how much and what type of risk it is willing to assume in the process. Dealing with a client base should be not be a matter of random prospecting, but should be backed by strong research about the nature of the client base, the value added that can be brought to that client base, a client's rationale for being willing to entertain an approach, detailed knowledge of clients' operating strategies and its level of financial sophistication. These points, which are summarized below, can be collectively thought of as the know your customer rule. This rather simple but often overlooked rule requires management on focused resources on predetermined customer segments and places the burden of knowing one's client on the shoulders of relationship managers, bankers, or originators of transactions and their respective managers. They must be intimately familiar with the client, its financial sophistications, motivations, and needs, and also be in regular contact to ensure that importance informed, that is credit related strategic focus management changes is forthcoming. This rule is also important from a legal perspective. In our experience, it is not uncommon for a salesperson to believe the firm is dealing with a particular client only to discover after credit sensitive transaction has been agreed to that the actual counterparty is a small offshore subsidiary of the parent company, absent a parent guarantee or collateral. The firm may now have ill advised credit exposure on its books. Thus, if a firm pursues a strategy to focus its resources narrowly on corporate institutions, it should not be dealing with highly leveraged funds or emerging market governments. The control requirements needed to monitor and manage such client relationships are very different. Likewise, if the firms intend to market to the deal with a very large number of clients in diverse sectors, it must ensure that it has sufficient internal and market resources to conduct such operations effectively. We propose later in this session a mechanism for weighting transactions and dealing with specific types of clients and products that are more susceptible to reputational and financial pain. How this can be proved? The first part is understand the client base. Second, understand the client's rationale for considering a relationship. Third part is understand the client strategy, financial and sophistication. And fourth, understand how to bring value added to the client based. The extension of credit on the establishment of non-credit financial relationship is based in the first instance on the financial strengths of the client. A client that is financially strong and demonstrates a clear capacity to make good on its obligations become a candidate for unsecured credit exposure, and a Broad financial relationship, a client that has strong financial resources but is primarily set up to manage funds using leverage and pledging its assets, or a client that does not feature the necessary financial strength may or may not be worthy of a financial relationship. Though posting collateral can mitigate some of the obvious credit risk exposure that might exist, other issues that related to reputation and motivation can arise and may skew these credit decisions. For instance, a credit that posts collateral to enter into a derivative transactions to hedge exposure may be considered acceptable, while one that uses the derivatives transaction to mislead regulators or confuse investors and auditors is certainly unacceptable, regardless of the collateral posted. Understanding these subtleties is vital. We cover the non-credit aspects of the business decision in section a credit officer narrowly making a decision about whether to extend credit risk to a counterparty or even deal with a counterparty on a non-credit risk basis typically relies on tools such as official company filing, for example, annual reports, 10Ks and 10Qs in the US, and so on. Company meeting, equity or rating, agency analyst reports, press reports, and general hearsay. One would assume that the first two are the most informative and accurate. We review detailed client risk considerations by splitting the counterparty universe into several categories. That are funds, governments, and charitable organizations. Other corporate counterparties, including financial intermediaries. First, funds. Most dealing with funds is based on collateral being pledged. It should not be concluded, however, that any fund willing to post appropriate collateral automatically becomes a good counterparty. There are at least three other elements that are critical to consider. Is the fund the sort of organization that fits the client strategy? Other is who else is doing business with the fund and how? Last is what legal issues surround the perfections of interest in the pledged collateral? Mutual fund and unit trust disclose reasonably detailed historical information, though rather infrequently. However, dealing with this community are not typically risk intensive as they are mostly prohibited from borrowing and using derivatives. The credit focus is really on leverage funds. We can conceive of splitting these universe into three categories of potential clients: the top notch, the acceptable, and the do not deal with. We can categorize the clients in this three mode. Which is that three mode? First is top notch, second is acceptable, and third is do not deal with. Means we can give priority to first. We can take few actions and awareness about second, that is acceptable, and we will not think about the last, that is do not deal with. This categorization is very subjective. but can be determined by the corporate risk group by analyzing one, performance track records, second, manager background and experience, third, dependence on a single or few individuals, that is key man risk, four, investment strategy, infrastructure and controls, five, sophistication of risk analysis, six, size and stability of capital and investor based, seven, historical dealing and experience with fund, and so on. A combination of performance result analysis, market activity review, regular on-site visits, and telephonic contact is needed to reach conclusions. Credit sensitive business with funds in the top notch category can conceivably be conducted on fairly aggressive terms, whilst dealing with the acceptables should be based purely on standard haircut policy with no exceptions. Those in the do not deal with category are best avoided to avoid the risk of the bank. We believe that it is vital to distinguish between funds in such a manner and conduct business accordingly. It is also important that such a categorization be reviewed frequently. Funds typically have a return experience that follow a bell curve. When they start out, they are learning the ropes. Then they start performing if they have all necessary ingredients. Eventually, however, success catches up with them and they revert towards an average performance. As a result, we might argue that categories paribus, the life of a fund can have more and less risky periods. Daily behavior of the fund, as observed by salespeople, risk professionals, and operational staff, can also serve as an important source of credit information. In-depth and real-time knowledge of the activities of a fund is almost non-existent unless a firm happens to be the sole prime broker, simultaneously the banker and custodian of the investments. This, however, is very rare. Funds are especially leveraged funds do not disclose much information about their dealing with other financial intermediaries for fear that it will be used against them. Again, the decision of whether or not to deal with the client and or what terms is very subjective. It is a massive game of poker. It must not be forgotten that LTCM was a top notch category client for almost everyone, or Wall Street the day before rumors of its demise started circulating. While a client's financial strength is perhaps the most important factor in determining whether obligations will be repaid, its willingness to pay must also be considered. Capacity related to a client's financial strength, while willingness, a much more subjective concept, relates to its desire to pay. As noted in the Orange County and PNG examples above, a very strong client that has the financial resources to pay its obligations. For example, a governmental institutions or well-funded corporations may choose or not to do so for any number of reasons. It may believe it has been treated unfairly by the banker. For example, it has been ripped off, that the risk protection is sought failed to provide the benefits desired, that much risk was embedded in trade, that the valuations were wrong, and so on. Though it is difficult to know in advance whether or not a client will willingly honor its obligations, regardless of financial capacity, a firm must be alert to the possibility that transactions that have a great deal of risk, are very complicated or unusual, have a greater likelihood of being challenged by an unhappy client, typically in a lost position. It is also true that the larger the potential loss, the larger the potentiality of an improperty claim, even if the financial agreements are straightforward. Thus, it is critical to choose the types of clients to deal with and the different types of products that can be marketed. It is also important to make sure that senior officials within the client organizations are truly on top of financial transactions and potential liability before and during the life of financial management. Government and charities. Governments and government related organizations should be dealt with only after very careful consideration. Governments, being ultimately potential as exposed to economic organism, have a habit of doing abrupt U-turns as political winds change or political gain is being sought. They also find it easy to lay claim to the argument of the weak versus strong and weaker, the large bank or corporation, which fuels the press in many countries. It is not surprising that there is a long history of certain government entities disowning loss-making transactions by claiming that the right people were not informed or authorized, that they were dealing outside of their legal scope, that is ultra wires, or did not understand the risk of the transactions. In short, an unwillingness to pay regardless of financial capacity. Examples such as the UK local authorities swaps defaults, the Orange County bankruptcy, and the Kingdom of Belgium currency losses mentioned earlier serves an important reminder. Those events can very quickly become very public and embarrassing, much to the dislike of financial intermediaries and regulators. Non-profit organizations, for example, religious foundation and pension funds, similarly have easy recourse to the public domain and should only be considered for business after very careful consideration. For these organizations, regulatory oversight should be well understood but not relied upon as a simple mean for concluding that official oversight is condoning their dealings. Other corporations and financial intermediaries. For all other organizations, including corporations and financial intermediaries, it is increasingly true that the accounting profession does not provide us with the whole picture, as acutely highlighted in the Enron bankruptcy. The reputation of the accounting industry and its ability to provide objective and informed analysis of and opinion on a company's true financial health have been temporarily and perhaps permanently impaired. Long gone also are the days when a well established name would require less scrutiny. Analysis start with measures of soundness of business fundamentals, diversifications of sources of income, quality and stability of management, and the shareholder base, competitive environment, and so on. From there, it moves on the financial statements. When it comes to the balance sheet, carrying earning and cash flow statements, disclosure rules, analyst reports, and rating agency review often do not provide sufficient information to be able to see through the financial conjuring that goes on. In particular, not enough attention is paid to off balance sheet activities and forward commitments. Yet, these are both critical for adequate analysis to be performed. For instance, with the focus on the Enroll debacle, the press has picked up on the fact that many of the offshore off balance sheet vehicle were not properly disclosed in the required filing, and those that were disclosed were done so in the most cursory way, buried deep in the footnotes of the statements. Lack of knowledge regarding forward commitments can likewise lead to misunderstanding about future liabilities and liquidity constraints as well as earnings. It is worth nothing that retail clients are not typically granted unsecured credit exposures as they lack the financial strength to support such obligations. Accordingly, credit analysis does not assume the same importance as it does with institutional clients. However, although secured lending against assets in client securities accounts is reasonably standard practices, financial institutions must still take care of to know their clients. Make sure that product transactions are suitable and that disclosure of potential risk is throughout. It is important for a firm to rely on its own analysis and judgment when it comes to making credit decisions. Though external equity and debt analysts provide certain services, they have different motivations and have proven on many occasions to have missed the boat when it comes to critical downgrading decisions. For example, Merrill Lynch debt analyst issued a but report on Russian ruble denominated debt 10 days before the default. Such analysts are unfortunately also influenced by their own particular circumstances, as we have all discovered in the debacle involving the independence of research on Wall Street. Against this backdrop, it is safe to say that over the past 20 years, the role of the credit officer and the skill set required of a greater credit officer have radically changed. In this, we have also seen after bank, government charities, and other corporations. In government charity, all the temples, all the social homes, And all ashrams are built under the Trust Act, which is always come in the charity sections. The credit decision business considerations. Within each client category, the need for information is constantly being balanced by business pra- practicability. Often, salespeople claim that the client will end a business relationship if a particular question is asked or too much information is requested. You must have to remind this when you will start your research. You should have a perfect format of questionnaire to ask close-ended questions, and few of them are open-ended questions. You may learn about open-ended and close-ended questions. Once through that barrier, a firm is often told by the client that other credit providers do not ask such questions. The implicit statement being that asking questions will lead to a lost business to more cooperative firms. Our feeling is that too few legitimate questions are being asked for the short term fear of losing business. Clients certainly are able to take advantage of this. Part of the client risk philosophy has to be a clear understanding of where management stands on this issue and dilemma. Our advice is that a firm must always be prepared to forsake business if it cannot get the information it requires, regardless of who the client is. But this needs to be clearly explained. This stance can sometimes prove frustrating for marketers, originators, and clients, while in the short run, it may not maximize earnings. We strongly believe that it will in the long run. No single dollar transaction or relationship is worth jeopardizing a great reputation for. Dealing with client suitability. A colleague once noted that dealing with customers carries an asymmetric outcome. There are no unsuitable transactions, only large losses. If they make money, clients are happy. If they lose money, they will take you to court. Whilst clearly a fair jaded view of the world, it is true that there is a risk to dealing with customers even if no credit is extended. BT ostensibly learned this lesson the hard way in the it's dealing with PNG, Gibson, Greetings, Sandoz, Air Products, Jefferson, Smurfit, Federal Paperboard, and other counterparties. JP Morgan learned similar lessons in 1998 when five of its Korean corporate and financial clients lost $757 million on derivatives. The bank had to set aside over $500 million to cover subsequent write-offs. Deutsche Bank, Nomura Securities, Merrill Lynch, and many others have also had to pay out on client credits, but they were, are, and will not be alone. I would like to say that all the students must have to prepare yourself to be joined in the top corporate banks or financial institution, just like JP Morgan or G Finance, Deutsche Bank. Nomura Securities, Merrill Lynch. As noted earlier, there is an undeniable responsibility for the financial intermediary to follow the know your customer rule to ensure not only that the customer is well aware of, appropriately empowered, and capable of understanding what is being undertaken, but also that the proposed transaction is suitable for the client. This is commonly referred to as the suitability test. The reality of the financial industry is such that there is always going to be an aggressive salesperson, a little joystick happy when close to a transaction, or a client that is totally in control of the circumstances but claiming ignorance ex post facto when things do not work out. So, how does a firm combat this and ensure that only suitable business is conducted? The only way to catch the transaction that ought not to have been entered into is to force a transaction review process ahead of time. To do so for every transaction is obviously not practical, nor it is necessary. Instead, it is best to choose certain types of transactions that are prone to problem and hope that this catches the majority of them. A firm could, for example, choose to review all transactions with one, tax or accounting motivations, second, special purpose vehicle, third, high gearing, where the customer could quite easily lose a charge amount of money, for large upfront payments or unusual cash flows, and so on. In short, transactions that are risky, non-standard, or which attempts to manage or legally circumvent regulatory, tax, or accounting issues are good candidates for review. It is also important to focus on client categories that are more likely to need scrutiny and submit them to the same review process. These might include counterparties that are more prone to disrupting transactions, those that are less market savvy, or those who enter into transactions as insiders. Again, care should be taken when considering transactions with one, governments or governments related institutions, which being more subject to the vagaries of prevailing political winds, have at times disowned loss making transactions, charitable educational pensions, or tax exempt organizations. Third, customer exhibiting unusual behavior, such as requiring upfront payments that represent a large proportion of their normal operating earnings. Four, customer that enter into derivative transactions for purposes other than hedging well defined exposures. For example, foreign exchange receivables, payable, or bond issuance. This is especially true when the transaction involves the corporation's own stock, for example, Enron. Fifth, note that as a general rule, very risky or complex transactions with retail customers should be placed off limits. Any exception to this, for example, offering leveraged structured notes to individual investors, should be reviewed to consider any special requirements related to appropriateness, disclosure, valuation, and so forth. In these sessions, we have discussed about loan sanctioned to government institutions. When we are finalizing the loan proposal of government institutions or the private institutions, those are carrying out the project of governments. So you should have to understand or study the political background, that if the party is elected newly, means it has a chance to be sustained up to 5 years. Means after setting the new political party in government, you can pay the loan up from first year, second year, third year. Means the project will be finished within 1 year, 2 years, or 3 years. Means your payment should be passed by the government, by that ministers, when they are on the ruling party. Understand? If the ruling parties 4 year completed and they have only 1 year, and a private person came to build a bridges or roads, will you sanction that loan or not? Because he will complete that bridges or roads within 1 or 2 years, and after 1 year the ruling party will finish their government and new election will be there. We don't know that this party will continue elected in next sessions or not. Okay, we cannot forecast. So keep in your mind that when you have to pass the loan, if you are a manager in loan section, an internal committee comprises of senior representative from relevant corporate functions, finance, risk audit, and legal, as well as senior business representatives unconnected to the transaction should review any potential deal that has these characteristics. The inclusion of business people is vital as it places a peer review burden on the transaction that should enhance the self-governance nature of the process, thus further help to neutralize part of the natural tension that exists between the business advocate and the corporate control functions. It is also useful to place a member of the external auditor team on the committee in order to obtain a neutral opinion. Meeting must be non-bureaucratic and easy to carry call at 24 hours. Notice so as not to be viewed as a burden and therefore a hurdle that needs to be circumvented. Attendance by senior level personnel should be mandatory and detailed minutes should be kept for the record. In order to determine the efficacy of the process, the status of transaction approved in the past should be reviewed on a periodic basis. A firm should always seek the opinion of counsel, internal and external, regarding a given counterparty's ability to execute specific transactions. Time and effort spent on legal due diligence, particularly for large transactions or extensive relationship, can be well worth it. In our experience, the mere act of forming such a committee stop many of the more opportunistic and outrageous transactions for even appearing. However, this process, even when it works, Well, it not felt safe. There will always be transactions that, with hindsight, should not have been done. When they do go wrong, having a rigorous process to point to will certainly help in the defense. Part of the process should, of course, include a post mortem on transactions that go wrong. This allows the firms to enhance existing or establishing new relationship and transaction criteria in order to avoid future problems. Other is towards better disclosure. We have already referred to problems to insufficient disclosure. This relates equally to non-profit organizations, governments, entities, funds, and other financial and corporate institutions. Disclosure for corporations and non-profit organizations, as well as disclosure in many countries not subscribing to generally accepted accounting principles, that is GAAP, is also problematical. Though US GAAP is taken by many to be the standard, it is certainly not the only valid one. There are many other acceptable ways of considering and treating the same kind of financial information. For instance, International Accounting Standard IAS, you may have learned about International Standard Accounting Standards. It is from 1 to 39, which many non-US companies adhere, is an equally valid standard, though one that often treats financial accounts differently than US GAAP. Consider just a few simple differences between IAS, International Accounting Standard, and US GAAP, but ones that can dramatically skew the presentation of financial accounts. Under IAS, intangible assets, investment property, plant and equipment can be revalued periodically above or below historical cost. Under GAAP, this practice is strictly forbidden. Under IAS, special purpose vehicle have to be consolidated into parent account when the substance of the relationship reflects control. Under GAAP, consolidation is based on risk and rewards. That is, who bear the risk and earns the profit rather than control. Under IAS, intangible assets that are acquired have to be capitalized and amortized over a period of less than 20 years, but they can be revalued. Under GAAP, they have to be capitalized and amortized over their useful life, which can be indefinite, but they can never be revalued. Under IAS, inventories have to be valued at the lower of cost or net replacement value on a first in first out or average method. Under GAAP, they are valued on a last in first out basis. Under IAS, impaired assets are written down to the higher of the selling prices or discounted cash flow value. Under GAAP, they are written down to undiscounted cash flow value. Under IS unrealized gains, losses in investments available for sale can be recognized through the income statements or the equity account. Under GAAP. They must be recognized through the equity account. And last, importance of managing this risk. One, ensure stability of banking system. Second, protects depositors and investors, improves profitability, ensures regularity, compliance, and prevent bank failures. Role of Basel norms. Basel 3 emphasizes capital adequacy for credit risk, liquidation standard, LCR and NSFR, risk governance, stress testing. Thank you. Today's session is over.